Today, we are analyzing one of the most significant structural shifts happening in global finance. Japan's latest economic actions are sending structural warnings across the global financial system. It is rattling Wall Street, spooking currency traders, and raising urgent questions about the future of American borrowing. It all began when Japan's government approved a massive stimulus package. This package, analysts warned, could undermine not only Japan's financial stability, but also the United States economy. As the yen tumbled to levels unseen in nearly a year, Japan's finance officials began signaling possible intervention to prop up their sinking currency. This collapse is structural, measurable, and it represents a profound turning point in global finance. We are watching the end of an era that lasted 4 decades. The myth of the anchor, the end of an era. For decades, Japan has been America's financial anchor. It has been buying more U.S. Treasury debt than any other country in the world. The subsidy. At its peak, Japan held $1.2 trillion in U.S. bonds. This massive holding effectively subsidized America's spending habits and kept U.S. mortgage and credit rates low for 4 decades. The debt trap. This era of cheap money allowed the United States to make the classic imperial mistake, substituting borrowing for prosperity, leading to chronic deficit spending and massive debt. The change. But those days are ending. Japan can no longer afford to subsidize America's addiction to cheap debt. The global financial arrangement is dissolving under the weight of Japan's own escalating domestic crisis. The 3 structural drivers of the dump. The narrative that Japan is dumping. U.S. bonds is an oversimplification of a policy-driven necessity. The sales are systematic rebalancing, mandatory foreign exchange intervention, and structural adaptation to fundamental policy divergence rather than chaotic liquidation. Driver 1. The yen carry trade unwind. For years, the foundation of Japanese investment in high-yielding foreign assets has been the substantial interest rate differential. This difference facilitated the profitable yen carry trade. The mechanism. The trade involves borrowing the Japanese yen at extremely low domestic interest rates and investing the proceeds in higher-yielding assets, such as U.S. government bonds. For decades, this was compelling, with U.S. rates often 5 times higher than those in Japan. The shift. Today, that calculus has changed. As yields on domestic Japanese government bonds, JGBs, surge to their highest levels in decades, Japanese investors suddenly have strong incentives to keep their money at home. The repatriation. This dramatic increase in domestic yield creates a direct incentive for major Japanese institutional investors, pension funds, life insurance companies, and trust banks to repatriate capital. This repatriation is essential for them to better match long-term liabilities in yen. When Japanese investors sold nearly $62 billion in U.S. Treasuries, that was an exit. Driver 2, policy-mandated FX intervention official sales of U.S. Treasuries are mandatory operations aimed at stabilizing the rapidly sinking yen exchange rate. The instability. The yen has fallen hard, losing nearly 8% of its value against the dollar over the last 6 months. This depreciation makes vital imports, like energy and commodities, massively more expensive for Japan. The intervention mechanism. When the yen rapidly depreciates past policymakers' perceived threshold, the Ministry of Finance, MOF, must intervene. The direct mechanism for this stabilization is the sale of U.S. dollar-denominated assets held in Japan's foreign currency reserves, which primarily consist of U.S. Treasuries. By selling dollars and buying yen, the MOF attempts to extract liquidity from the market, reducing the yen's volatility. The paradox. This confirms that a form of policy-mandated dumping occurs, driven not by market timing or yield, but by the non-negotiable goal of domestic currency stability. Driver 3, domestic fiscal collapse and liquidity needs. Japan is structurally trapped by its own debt and domestic economic needs. The debt burden. The country is drowning in debt that is worth 235% of its GDP, the highest in the developed world. The stimulus trap. Tokyo has approved an incredible 21 trillion yen stimulus. This massive spending is funded through bond issuance. Ironically, this large influx of printed money is intended to combat inflation and save critical sectors like the auto industry. The last card. Selling the enormous stockpile of U.S. Treasury bonds is one of the only viable options left to raise liquidity and fund domestic needs. This liquidation exposes a deep need for liquidity that the domestic market alone cannot fulfill. The terrifying warning to the world, contagion and cost. Japan's structural retreat is a profound turning point in global finance that directly raises borrowing costs for everyone. The erosion of the financial anchor. The fundamental warning is the accelerated erosion of the historical financial anchor for U.S. debt, stable sovereign demand. The cost to America. The 4-decade run of cheap borrowing subsidized by foreign buyers is over. You are already feeling the effects of this. Mortgage rates that were sitting near 2.6% during the pandemic are now hovering close to 7%. Credit card rates and car loan rates are at record highs. As Japanese investors step back, buyers of U.S. Treasuries demand higher yields, raising borrowing costs for corporations, for consumers, and the U.S. government, too. The fiscal shock. Reduced foreign demand directly increases the cost of U.S. debt. This shift forces the U.S. to rely on price-sensitive private investors who demand a higher risk premium to hold long-dated maturities. The contagion risk, the unstable link. The global market is a synchronized system. Instability in the JGB market immediately impacts U.S. financing costs through shared investor psychology and globally integrated risk models. Yield contagion. The surge in JGB yields creates a contagion effect on U.S. Treasury yields. The carry trade time bomb. Even more dangerous is the carry trade unwind. This global financial machine, built on cheap yen, fuels everything from U.S. stocks to emerging markets. When Japan's monetary world wobbles, that entire trade can unwind in days, triggering rapid market volatility. The geopolitical double whammy. The retreat of Japan, a major financial ally, coincides with the strategic reduction in U.S. debt holdings by mainland China. China's strategic exit. China, the other historical anchor of U.S. debt financing, has also seen a sustained strategic reduction in its holdings. While Japan's motivation is monetary and reactive, China's is often viewed through a geopolitical lens of de-dollarization and strategic adjustment. Compounding risk. The simultaneous reduction in stable sovereign demand from both a key friend and a strategic rival magnifies the systemic risk posed to the U.S. Treasury market and contributes to the long-term erosion of confidence in the U.S. dollar's role as the world's primary reserve currency. Lessons from history, debt, and confidence. History is clear. Debt makes you look rich until the bill comes due. The collapse is usually foreshadowed by the denial of unsustainable debt. The bubble principle. Every bubble feels unstoppable until it bursts, and the people who believe it can only happen are always the first to be crushed. The sheer volume of U.S. debt ensures that when confidence cracks, the shockwaves will shake the entire global system. The only choice. Americans need to prepare for a world where money is no longer cheap. The era of easy money is over. Diversifying into real assets, gold, and commodities is now a necessity against volatility and policy failure. The only defense against policy failure is financial education and resilience. The 40-year arrangement that allowed America to borrow cheaply is over. The transition will be very turbulent, but understanding what's happening and why is the first step in preparing for a world where a new, more uncertain financial chapter has already begun.